It's the scourge of savers and governments, and a topic of fierce debate as we head into President-elect Donald Trump's second term of office. It's inflation. Anger over the cost of living helped propel Trump back to the White House. But concerns his economic plans will reignite inflationary pressures are nagging the US bond market. So this week on the show, we thought we'd look at inflation with one of the major players in that market, Rick Rieder, Chief Investment Officer of Fixed Income at BlackRock, the world's biggest asset manager. And we take a brief detour to the night markets of Harare to find out what happens when inflation hollows out your currency. It's what we do here on Reuters Econ World. Every week, we pick a phrase or buzzword and go deep on the economic principles and ideas driving the biggest news around the world. So this week, inflation. I'm your host, Carmel Crimmins, in Dublin. Okay, before we get into this, let's get down to basics. What exactly is inflation? It's a general rise in the price of goods and services. High inflation means prices are increasing quickly, while low inflation means they're growing more slowly. That's an important distinction. It means that when central bankers talk about moderating inflation, that doesn't mean the prices are falling. It just means the pace of increase is easing off. And if your income isn't keeping pace with those price increases, then you'll be worse off. That's why discontent with the cost of living is piling pressure on governments around the world. It was a key motivator for voters choosing Donald Trump as the next US president. But markets are betting that his plans to curb immigration, cut taxes, and raise tariffs will fuel inflation. So will they? Who better to discuss this all with than with a bond investor? They're always on the lookout for inflation because it cuts into their returns. And Rick Rieder has plenty of bonds on his books. He manages a mere $2.4 trillion in assets at BlackRock. How worried do you get about inflation, Rick?
I mean, it is, if you marry it to growth, those are the two things that I'm focused on, but really directly for bonds, it is inflation. And, it is, we follow when the CPI report comes out, it's kind of, you think about how trivial it is, but we follow like every 200 basis points.
Yeah.
And then you build out, what are the component parts? Why is shelter inflation still high? Why is it not coming down? Why were used autos? So we watch it like a hawk, like you say. It is, as a bond investor, it is the driver of what we look at.
Historically, inflation dominated the US economy. It dominated the global economy kind of from like the mid-60s to the early 1980s. And then it fell off a cliff, only to come roaring back during COVID. Do you think that kind of lack of personal experience with inflation really fed into the anger that ordinary people felt about the cost of living crisis?
100%. You think about for almost 2 decades, what central banks are trying to do is create more inflation.
Right.
They're trying to create more inflation.
Yeah.
And now, after COVID, think about, the logistics, supply chain, huge amounts of monetary stimulus, fiscal stimulus. Like you had so many engines to create more inflation, and then too much.
Yeah.
By the way, I'll throw out one thing that is also wild, is there's a cultural evolution taking place. So like the demand for experiences, the demand for services, it's demographic, it's cultural, like the demand for healthcare as the population ages. The demand for education as the population grows in many places, what have you. Like service level inflation is what's hard to get down. And by the way, I always use the example.
Yeah.
Like when you go to a Taylor Swift concert, like how do people pay?
All right. I haven't been able to get a ticket, Rick. I wouldn't know.
But some of it, you think about what it is. Cultural change, the demand for something that is so unique. There is a cultural dynamic around people want to spend time with other people. And you see this in people want to travel. They want to go to dinner with friends. They want to go out to have a good time together. They want to go to Taylor Swift. Yeah, the evolution of I grew up and it was, it was like, could you buy a TV or could you buy a radio or a car or what have you?
Things.
Things.
Yeah.
Like now it's services. And by the way, you think about, like it used to be, like what can you do on your phone? Like it used to be, you had to buy an alarm clock, you had to buy a stopwatch, you had to buy like all these things. It's not on your phone. Like I don't need any of that stuff anymore. And it's just a cultural evolution. So by the way, part of why the central banks have a hard time with that, it's like, how do you get that inflation down? Pretty hard. Interest rate doesn't get it down. So it's a bit of a conundrum.
Do you think, though, that demand for services, do you think that's a legacy of COVID and that it may eventually filter out? Like, or do you think it's a structural shift, it's a permanent change?
Permanent. So, I think, so first of all, coming right out of COVID, there was this big jump in goods inflation because people had to buy a car. They hadn't bought a car for a while, and furniture and et cetera.
Yeah.
And then obviously get out. I want to travel. I want to do things. But I definitely think there's a structural dynamic at play that is real. And I think a lot of it is because you can do so much on your phone. The things that when I grew up, you needed.
Yeah.
Like you don't need that stuff today because it comes to you.
Yeah.
But now I want to, it's very much quality of life. Like that is a structural demographic change.
It seems like anger over inflation, anger over the cost of living really made an impact, on the vote in the ballot box on November 5. Were you surprised by that?
I was surprised at the extent of it. And I'll throw out one thing I've used this example before. So traditionally being in the bond world,
yeah,
when you raise interest rates, you bring down inflation. But something very unique just happened where you think about interest rates were low. People globally locked in their mortgage at a very low rate of interest. So think about what just happened. Interest rates went up significantly. Mortgage rates went up significantly. Why is inflation and shelter cost of living so high? It's quite frankly because people they're stuck in their mortgage. They can't move. So ironically, if you bring down interest rates, you bring down the mortgage rate and home builders will build more houses. So you'll actually bring inflation down. What people are angry about is you actually can't move. And you can't, the normal evolution of your life, the way you create wealth, and I move to a house and I create a family or what have you. Like when they raise rates, and there is a lot of anger around that. And there's a lot of anger around, gosh, I can't buy a house. I can't do the things that I want to do. And, I'll say one other thing that's also a big demographic shift that played out in the election. When you raise interest rates so significantly, you have an aging demographic where the people that are older actually have no debt and they have all savings. And when you raise the interest rate, they get more money.
Right.
So what happens is you create a two-class system. People that have a house that, need to borrow to buy a house or borrow on their credit card are having a really tough time. But a lot of the population that is aged and has actually paid down their debt and is now a saver.
Doing really well.
Is actually doing really well. So exactly like you say, half the population is having a tough time or more.
Right.
And they voted along those lines.
So what you're saying is that raising interest rates is not really the answer to fighting inflation? They aren't as useful as they once were?
So the first thing was when we had that conversation about goods versus services.
Yeah.
When you create goods, you think about commodities, manufacturing, you raise the interest, those have to be financed.
Right.
You raise the interest rate, you slow down the production there. It has nothing to do when you're doing something in services or healthcare or education.
Yeah.
Interest rate doesn't make a hill of beans a different. Companies, and some of it was post-COVID, are sitting on so much cash. If you raise the interest rate, they actually have more money. And which is ironic relative to anything we've ever seen before. The other side of it is historically banks used to borrow short, lend long. Like banks are much more sophisticated today than they used to be. So all of those things have made the interest rate tool incredibly blunt and not nearly as effective as it used to be. And so, by the way, should the Fed have and central banks raise the interest rate from 0? Yes. But then you reach a point where actually not only does it not help, it actually, like I talked about housing, it actually promotes more inflation because you're creating an inability to create housing affordability. So anyway, part of it is if you're a central bank, you can only do so much, and then the rest needs to fall on the fiscal engine. And there are a lot of tools as fiscal you can do, capping apartment rental rates, capping returns people can have from investing in certain areas that keep prices high, et cetera. So it used to be historically that you had interest rate and then you had fiscal policy or the government tools. You need both of the tools to work.
Right. Because I was going to say we've covered Turkey quite a bit in this podcast, looking at the kind of unorthodox ways of fighting inflation. So you're not suggesting a Turkey style, keep cutting. That's not what this is about. It's just that interest rates can only go so far, in your opinion, to deal with inflation, given how the economy has changed.
By the way, I'd say the flip side of it is I never understood negative interest rates.
Okay.
Doesn't work.
Yes.
And but I remember telling my kids, like, I was paying companies money I was paying them to take my money. And they're like, Dad, why would you ever do that? And I'm like, and the more I think about it today, I'm like, wow, that's pretty stupid. But you think about it, I mean, that's where the central bank had the risk-free rate. Anyway, point being, monetary policy, the interest rate tool works in a range, and then when it gets to excessive levels, either way, the utility of it goes away.
There's a big disconnect, isn't there, between Wall Street and Main Street over inflation? Like on financial markets, inflation as a concern can be in the rearview mirror, but in everyday life, high prices can be still very much a thing.
I think the discussion of inflation needs to be much more specific.
Mm-hmm.
Because I think, like you said, there was a lot of anger out there. And, quite frankly, things like gas prices are hugely critical to most of the population. Home prices,
Yes.
3/4 of the wealth of the United States are in people's homes.
Mm-hmm.
So there are a lot of people that the price of your house, your ability to move, the affordability rate, gas prices, food prices, those things are very, very specific and the idea, I always find, like in the financial markets, everybody wants a simple answer. Like, just give me the one-word answer.
Yeah.
Fed was hawkish, dovish. They want a one-word answer. Inflation's 2.5 or 2.75. But inflation is incredibly complex that, you can run at 2.5, 2.75. But if for whatever reason shelter, like you saw in the CPI report, if shelter's too high,
right,
it's a problem for much of the country.
Yeah.
And so targeting one number, and the central bank's targeting one number, is kind of an amazingly imprecise endeavor.
So should they change it? Should they change like what they're targeting? Like, do you think there should be like an overhaul of how we measure inflation?
Well, first of all, I think the range of inflation, say a 2% target, over a medium term, very helpful.
Mm-hmm.
But you can operate in a wider range. But the specifics and by the way, I think the central bank can only do so much. The central bank can't attack the specifics. The government, the fiscal, can attack the specifics. As long as the central bank has you in a range that's reasonable, they can get out of the way and then let the fiscal do their thing. But yeah, I think you just saw it, like you said, play out in an election. Like, we're just not getting there for a lot of the population. But a lot of what has to happen has to be, quite frankly, from the fiscal side.
So we've all learned the hard way that inflation eats away at your spending power, but it can also clobber your currency. Look at Zimbabwe. It scrapped the Zimbabwe dollar after inflation peaked at 500 billion%. Yep, you've heard that right, 500 billion% in 2008. People lost their savings, their pensions, and all confidence in the currency. Fast forward to today, and Zimbabwe is on its 6th attempt at a currency, the gold-backed ZiG. In the capital, Harare, market traders still prefer the US dollar to do business. Selling goods on the street is illegal, so they hawk their wares at night to avoid being spotted by police. Tafadzwa Goma sells second-hand clothes and says his suppliers don't accept the ZiG. They prefer the dollar. So he just uses the local currency for his own personal use. Give Mormanacho, another clothing trader, accepts both the ZiG and the US dollar, but normally uses the local currency just for change. Are you more worried now about inflation as we head into this new administration? Like, most economists seem to think that Trump's plans for immigration, for tariffs, for tax will be inflationary. That seems to be the consensus trade. What do you think?
I think it's too simplistic.
Okay.
I think, first of all, the president-elect ran on we're going to reduce inflation, and he said promises made, promises kept. There are some tools around deregulation. There's some tools deregulating energy, deregulating a number of industries to bring the cost structure down. I don't think they're going to do a global tariff, but I think they can threaten it, and I think they can use it as a tool. And then the last thing, the next 2 years, 3 years are going to be the most extraordinary change in terms of automation in the world. And I don't think people recognize that how automation, and you're seeing it through AI, through technology, And I think automation, like AI, there are a number of studies that say AI can replace 35 to 50% or augment 35 to 50% of the jobs. Like a lot of what drives inflation is wage pressure. Well, that changes the wage pressure algorithm quite a bit. So I think anybody who says, I mean, I don't think I think inflation over the next 6 months could trend a bit higher, and I think the fear of it could be a bit higher. But anybody who says that they know what it's going to be a year from now or 2 years from now,
Yeah.
I think is arrogant.
You sound like a techno-optimist there for sure, right? You don't think the claims about AI are overblown, might be exaggerated in terms of impact on labor market or just impact in general?
No.
Okay.
I think we're going down the road of automation and, the ability to create efficiency. And I think, we talked about the phone and, people say, well, there hasn't been that much technology or productivity enhancement over the last decade or couple of decades.
Yeah.
I mean, how do people not say internet, GPS? And it's hard to measure. Think about the extraordinary efficiencies it's created. And over the next 2-3 years, the ability to create goods and services and to have automation augment how we do everything you just go from documentation to lower skill responsibilities, et cetera. It's going to be, I think it's quite real.
Okay.
And the amount of money, part of why your question about inflation in the near term, like the amount of money that has to go in to build it
Yes.
is energy costs, cooling costs, huge. But I think the other side of that is pretty impressive.
So in terms of the Trump administration, you think there will be things done on the regulatory side and there will be rhetoric around trade, but the extreme scenarios perhaps won't be implemented. And then there will be advancements made in technology that could help even out inflationary concerns. Is that right?
Yeah.
Mm-hmm.
Elon Musk knows a few things about automation and technology, and he knows a few things about how to make things more efficient. So I think that'll be interesting to watch.
Well, that is interesting because, we focused an awful lot, and I say we, the media in general, commentators have focused very much on the tax cuts that have been sort of promised. But there could also be perhaps a kind of a Musk-led purge on spending as well. And so do you have a view on where we might end up in terms of the budget deficit then?
So I think they're going to be laser focused on it because it's a really, really big deal. And I think, I will say one thing. I think they're going to cut spending. I think they'll do some deregulation. We've gone through it. It's hard to cut a lot of spending.
Mm-hmm.
And there are not a lot of things that aren't very sensitive in the economy that are easy to cut. So I think what happens is you outgrow the debt and the deficits through the investments you make in things like infrastructure that have velocity to it. Meaning if you build a chip manufacturing plant or an airport, you put money in at the beginning. And by the way, there's public-private partnerships to do around that. And if you build that, you hire people to build it. It has offtake for years, and it creates growth that helps bring and by the way, growth and taxes that bring your debt and your deficits down. I think cutting spending, I think they're going to do it, but I don't think it's as easy as people think. And I think a series of initiatives, and by the way, some of the areas that are strategic to the United States, such as chip development, like those things, to invest in those to help grow, and the amount of money, like we talked about before, that goes into energy, et cetera, are pretty significant and can create real growth if done right.
A big thank you to Rick for his time and insights, and to Nyasha Chingono for his reporting. You can catch all our stories from Zimbabwe on Reuters.com and the Reuters app. Sound design, music composition, and engineering on this episode was by Josh Summer. Our podcast team includes Kim Vinnell, Tara Oakes, Gail Issa, Jonah Green, Christopher Walljasper, David Spencer, and Sharon Reich Garson. Our executive producer is Leela de Kretzer. Remember, for all your daily news, check out our weekday show, Reuters World News. You can catch it on the Reuters app or wherever you listen to your podcasts.